Welcome to the Big Skinny with Lou Basenese, and I'm Lou Basenese, where we bring you nothing but filling, no fluff. You're probably wondering, really, where the heck did we get this name from? Well, let me tell you. Urban Dictionary defines the Big Skinny as insider information. That is definitely not something we're going to provide. Although I'm not regulated by FINRA anymore, I'm still not looking to end up in any orange jumpsuits. I love my orange and blue for the Gators, but not orange in a state penitentiary. So I'm going to go with the alternate definition here of the Big Skinny, and that's really providing essential information, essential truths, and that's what it's about. In a world of information overload, I want to be a voice of reason and clarity that curates what matters for you and do it in a way that's easy to digest. I mean, if I had to think of an analogy, I'd say, consider me the Dave Portnoy of pizza reviews, but for financial news. I mean, everyone knows Dave, right? His whole one bite. Everyone knows the rules. Everyone also knows Dave always takes more than one bite. In fact, actually, I got to correct that. There was one time I saw where he only took one bite, and that was because the pizza was crap. It was probably from somewhere not in New York or New Jersey. So we're going to follow a similar rubric here, but instead of one bite or 2 bites, 3 bites, we're going to provide you one headline that could be misleading or leading you in the right direction, one chart that's going to have a key data point for you to follow and to pay attention and hopefully make money in the markets, and one investment insight, because let's be honest, everyone is here to make money. I know that well and clear. I expect you to speak up when we don't and to clap when we do. We're streaming on multiple platforms right now, so please do not be shy. But that's what we're about here at the Big Skinny, getting to the bottom line of what matters. In this show, we are going to go through a standard format each time as well. We're going to start off with a rundown of 3 topics that I think are relevant for you. We're going to follow that with one technology, executive, company, or trend that I think is really interesting for you to know and possibly buy. After that, we're going to bring in a fellow market pro and friend to give us their insights, because I'm smart enough to know I'm not that smart, that there are other people that have plenty of other insights that are valuable. And look, selfishly, I want to make money too. And if I've got good friends and good places that can help us all make money in the markets, I want to share that with you and share their expertise with you. So today we're going to do just that. We're going to follow that up with some good old-fashioned Q&A. I want to make sure that anything I say is not too hard to understand, or maybe I didn't hit the point, hit the mark. We're going to bring in a good friend and my fellow partner here on the Big Skinny, the big in the skinny. And I'm supposed to be the skinny, but I got some weight to lose still before I can qualify for the skinny. But we'll get there. Oh, thank you, Taylor. Said I'm beautiful. But anyway, then that's it. We're going to wrap it up. So all along the way, we want this to be easy to understand for anyone, but hopefully enough information and in-depth that you can appreciate and take away from it. So with that being said, let's go ahead and get to our rundown. Jumping right in. Got 3 topics to cover for you today that I think are really timely. And the first one, stock valuations, oh my. Now look, running into this week where we had the Trump bump before we got the Trump slump, you saw a lot of headlines that were just bemoaning valuations. In fact, they borderlined on fear-mongering that we're in another dot-com era. The reality is, though, that these headlines across MarketWatch and Bloomberg, all numerous, touting that, look, stocks are going to go down because they went up too much and they're too expensive. Now, on face value, that sounds logical, but here's what the data says. Stocks don't drop because they get too expensive. In fact, if you look here at this chart, it shows that there's absolutely zero correlation between stock valuations and stock performance in the next year. So if you can't see this scatter plot, which looks like one of those ink blots for a psychological assessment, let me break it down for you. This is looking at 1-year returns for stocks in the S&P 500 based upon their price to earnings multiple, based upon how expensive they are. If you can discern any trend from that scatter plot, you're crazy. Here's what matters instead, not valuations, but earnings. Earnings always lead stock prices higher or lower. So if profits are going up for companies, stock prices are going to be going up. If profits are going down quarter over quarter, stock prices are going to be going down. And guess what's going on right now? Well, not right now today and this past week when stocks have been selling off, but what has been going on is earnings are going up at a breakneck pace. In fact, if you look at Q4 earnings for the S&P 500 companies, that's 500 of the largest companies in America, their earnings are up 18.2% in the fourth quarter. That's the fastest growth rate in over 3 years. So, like I said, if earnings are going higher, stock prices are going higher. And guess what? The full year projections for 2025 are for S&P 500 companies to report earnings growth, not declines, of 12.1%. So the next time you read a headline that stocks got to go down because they went up too much, go back and look and see what's happened for the markets over time. They're up and to the right. They go up more than they go down. In fact, if you want another data point to hang on to anytime you get scared, we're now 28 months into this bull market. Guess how long the average bull market lasts? 67 months. 67 months. That means we have roughly 30 months to go, 3 years almost of partying and nonstop buying of stocks. Well, we don't want to exactly do that. I do want to give bears some credit here. We should not be blindly buying overpriced stocks, perhaps. Maybe not chasing every dip in the S&P 500 and the NASDAQ or the Mag 7 stocks. But what we should be doing is staying invested in the market. We should be looking for opportunities, for value, because these markets are headed higher from here as long as earnings are going higher. And we're going to touch upon that later today with my good friend Tom Hayes, who's joining us. So stock valuations, oh my, I don't care. It's all about earnings. Show me the earnings and I'll show you your future returns. Next up in the rundown is, should we go international or stay domestic? This is a headline that's out there, super prevalent now. People are shunning big tech because big tech's gone up too far, too fast for too long, saying we should buy European stocks perhaps or international stocks. And look, I'm not going to say that's incorrect logic. If you look at the valuations for European stocks, they're exceptionally cheap, as this Bloomberg headline details, right? But if you look here on this chart, it's the forward 12-month PE ratio for the S&P 500 for emerging markets and for Europe. This is a huge gap. This is a gator chomp gap. At some point, that mouth is going to close, right? Bring old Tim Tebow back for you, or Tim T below 6 foot, as my buddy calls me. I'm not Tim Tebow. I'm Tim Tebow below 6 foot, as my buddy Dave Maddox says. So I'll take that nickname with pride. But if you look at this, it's arguably very cheap in Europe and emerging markets. But let's talk about what's happened over time. Europe and emerging markets have been cheap for years. I mean, if we look at the 5-year total returns and outperformance of U.S. versus international, we've got 13 years of U.S. stocks outperforming international stocks. So eventually this tide will turn. Is it now? I can't tell you for sure. I can tell you that European stocks are cheap universally. Emerging market stocks are cheap universally. So what's that mean from an investment standpoint? It's very simply this. We don't want to move completely out of U.S. stocks, and here's why. I want to show you this. Look at the far right. This is S&P 500 companies that have more than 50% of their revenue coming from overseas. And look at their earnings growth rate, 20.8% in the last quarter. So you can own U.S. stocks and get European and international exposure. And remember what I said about earnings. When they're going up, stock prices are going up. So in an upcoming issue of the Big Skinny newsletter, which you can check out at our website, bigskinny.com, and subscribe there, we're going to talk about some U.S.-based stocks that have very solid European exposure. But you also don't want to abandon U.S. stocks and move all that money into European stocks or international stocks. I think you want to tactically allocate to them. So what does that look like? Well, here's what I want to tell you. I don't have an edge in Europe. I don't have an edge in the Far East. So trying to find individual stocks in foreign markets is a very risky proposition. Instead, play it with low-cost ETFs. And like I said, in an upcoming issue of the Big Skinny newsletter, we'll share some of those ideas for you for potentially 20, 30, 40% returns as you see this valuation gap get close. Now, rounding out the rundown, is a rotten Apple? Is Apple really no longer the stock to own, the best of the Mag 7? Well, if you ask Mark Zuckerberg, maybe he's, I don't know, not happy that he doesn't have a bromance with Donald Trump like Tim Cook does. He slams Apple in an interview saying that they haven't invented anything in a great while. Mark, you know what Apple invented? Stock gains. Yeah, I'll give you credit. Meta's doing awesome too, but look at this 5-year chart of Apple. It does nothing but go straight up. Put up the max chart of Apple. It goes nothing but up and to the right. Look at that. Parabolic gains, almost 1,400% since Tim Cook took over from Steve Jobs and everyone said that Tim Cook couldn't innovate his way out of it. He doesn't have to. He just has to iterate. And here, let me drive this point home. Apple does not have to come out with a great new product or a great new technology. When you look at their installed base of devices, it's steadily grown over the years from about 1 billion devices in 2016 to now over 2.35 billion devices. And if we look at the services revenue that gets generated from that alone, I believe we have a chart to show you that this is innovate or die? Not hardly. The blue shows how many devices are out there. The orange shows how many billions in revenue, annual revenue from just one segment, services. So apps, think App Store, services. Now, if we compare that to other companies' total sales for the year, NVIDIA's at 130 billion in the last 12 months. Apple's services division alone had 96 billion. It's basically the same size as Tesla or Disney's businesses on a whole, which are putting out about $96, $97 billion a year in trailing 12-month revenue. So the investment takeaway here is don't bet against Apple. Apple's a ride or die stock. Buy every dip. I've been doing it since 2014. It doesn't serve me wrong. Do your own research. That's not a recommendation to buy. That's a screaming endorsement to buy and put some Apple in your portfolio. All right, that's it for the rundown. At this point, we're going to pause to get a word from our sponsor. But before we do, I want to make sure you go to bigskinny.com. If you're listening to us and you haven't signed up for our newsletter yet, it goes out 3 times a week. So please go ahead and join bigskinny.com. And now we'll pause for a word from our sponsor. Well, this is where our sponsor would go, right? If we had someone to sponsor us, we would put that ad here. So today's episode of The Big Skinny is proudly sponsored by Oops, We Forgot to Get a Sponsor, Inc., your one-stop shop for awkward silence and unpaid ads. But hey, don't be like us. Get your brand in front of millions, thousands of tech-savvy, stock-watching, snack-munching fans who tune in just to hear us talk about stuff we Googled 5 minutes before the show. All right, maybe 7. Your ad could help us buy lunch. We're down the ketchup packets, according to Dodd. Pay for Dodd's Chinese food addiction and get me a new no, I'm not reading that. A new pair of platform shoes. No, sorry. I don't need them sometimes. So don't miss out. Email info@thebigskinny.com today and make this awkward silence a distant memory. Trust us. Your brand deserves better than this. Info@bigskinny.com if you're interested. We'll take a quick break and come right back. Fastest pee break in history by Lou Basenese. We are back and want to make sure you remember you can leave comments, ask me questions, give me scathing criticism, fire off your best shot, good old Pat Benatar. We're here for it. We'll do our best to answer it. Just don't be offensive. We're trying to keep this PG-esque. So, all right, now some of you know me for a long time as a disruptive tech guy. I love new innovative companies, technologies, platforms that are going to change the world and change the way we live in it. I've had a good history in the markets of making great money in that. Things like the iPhone, that's why I love Apple. There was a small company not long ago that made the hardware that was reading the fingerprints that was part of Touch ID and enabled Apple to get into mobile payments. And I bring that up because something as significant as the launch of mobile payments and biometric authentication is probably happening now when it comes to cardiac care. And this is a company that, full disclosure, I am an investor, participated in the last deal. I'm a long-term investor in this because I think the upside is tremendous. This is a company that has a simple device that I'm holding right here that can give you the equivalent of a 12-lead ECG that you would get in the hospital if doctors thought you were having a heart attack, mobile, ambulatory, with you at all times. So I won't go through the embarrassment of unbuttoning my shirt here on live streaming TV to do the demonstration. But yeah, I know everyone's happy in the studio about that. So would you be surprised if I said I don't have any pants on? No, just kidding. What I want to do is talk to you about how this company and this device could possibly disrupt a huge market that leads to $80 billion worth of waste in the medical system. So this is a company that has developed this device. I want to show you the demonstration. They have a video, luckily, that we can show this to you. I always think new technologies are better when it's shown. Don't just tell me about it. So it's an app-based device. As you see, you have the device here on the table. You open the app. You can start recording, whether it's just a normal recording or you think you're having a cardiac event. It very simply talks you through how to administer the device to your chest to put it in the right locations to get that reading. Constant feedback. I got to give the company credit. They've made tremendous strides in the user interface here where it's just super easy to use. I've been doing this on an almost daily basis. It takes a 30-second reading of your heart and gives you feedback. Those green circles you see on the screen there tell you when the sensors are in the right place. Once it's done, you tell the app if you're having any symptoms. And then it's going to send that equivalent 12-lead ECG reading to the cloud where a cardiologist can review it to make sure that you're not having an event that needs immediate attention. So think about this as heart attack detection in your pocket. I mean, how many people here? I mean, maybe I'm just of that age. I'm 47 now. You start hearing about people in their late 40s having heart attack events or heart events, irregularities. Who wouldn't pay for peace of mind to have that with you? So there's a very obvious reason I'm an investor, and I don't like to do all the talking. I want to bring in the CEO of Heartbeam, Rob Eno. Rob, welcome to the inaugural show of The Big Skinny. You are a brave man, I tell you that much.
Well, thrilled to be here, Lou. Thanks for having me.
Yeah, so listen, I try and give a summation of what I think is really the disruptive qualities of Heartbeam, but why don't you give us the background story? Because I think, how the origin of this device came about is really important for everyone to understand.
Absolutely. So our founder, a guy named Branislav Vidic, early in his career, he was at Intel. He actually was the co-inventor of flash memory when he was at Intel. But he grew up in Europe. His father was a physician. And despite that, when Branislav was a teenager, his father had a heavy lunch, thought he had indigestion, and unfortunately died a couple hours later of a heart attack because he had ignored the symptoms and mistook the symptoms, even though he was a doctor. And this is actually quite common. Patients are not aware of the symptoms or they're just in denial.
Right.
So what Branislav set out to do when he finished his career at Intel is, how can I develop a personal heart attack detection device that patients could carry with them?
So wait, so he finishes up developing the flash memory and says, I haven't done enough in my life yet. Let me go completely different field and solve another major problem.
Exactly. Yeah. And, a classic disruptor, he went and started talking to cardiologists and got laughed out of the room in a lot of places. And finally, an electrophysiologist, a special cardiologist who specializes in the heart's electrical signal, said, there was technology 50, 60 years ago that was an alternative to 12 lead called vector cardiography. And what that does is it takes the heart's electrical signals in 3 directions. So like side to side, up and down, and then into the body. And once you have the heart's electrical signals in 3 directions, you then have everything and you can create or synthesize a 12-lead ECG.
So that, for clarification for everyone here, when I'm getting a 12-lead ECG in the doctor's office or in the hospital setting, they're putting those patches all over me, and that's giving them the 3 dimensions, but with a very kludgy way to do it because it's
what that's doing is it's actually 10 electrodes, 12 leads, and the leads is basically a single representation. You've seen those strips. So it's taking all that information and giving them 10 specific views of the electrical activity. So what we can do is take the heart's 3-dimensional activity and then create exactly those same 10 leads or 12 leads that they're getting with all the kludgy device, but do it with that small device that you showed.
Yeah. So truly groundbreaking in terms of, you got your first FDA approval, which was for the device itself to collect data, right? But not for the algorithms, which is the next FDA approval that you're seeking.
Correct.
And at that point, you'd be able to commercialize. So let me ask this question, because I think AI is such a big buzzword now. This isn't just about a device that could save lives, but how is AI changing the landscape of what Heartbeam might be able to do with its device?
Yeah, it's a great point. So there's a lot of excitement about AI. There's a lot of hype about AI as well. And I think one of the real demonstrated use cases of AI is taking the information in a 12 lead ECG. If you've seen those, there's a ton of information that's embedded in them. And a number of academic centers have looked at applying deep learning to 12 lead ECGs. And what they can do is they can, delve into the ECG, and they can determine, even if the ECG looks fine, there's information in there that is predictive of events. So you could have a perfectly normal ECG, but it could say you have the likelihood of developing a condition, atrial fibrillation, heart failure, etc. So it's really providing these great predictive insights. Now, those can be applied when you go into the hospital and get a 12-lead ECG. One of the things we're exploring with our AI team is applying those same algorithms to the 12-lead that we generate. And if we're able to do that, then every time you were to take a reading with our device, we would be able to run those algorithms and provide those predictive insights to emerging conditions.
Yeah, and so I want to make a point too here. This is another thing that I think is always important. People always ask, like, what's important when looking at new disruptive technologies? IP, right? Having the patents that protect, because if you don't own the technology, you can't commercialize it. You guys have a very robust and expanding patent portfolio, but also you have the team that is essential. So why don't you talk about your background a little bit in commercializing, and then the rest of the team? I'm talking, Richa coming over from Apple, Tim having done this at Petamed, even Lance Myers coming over from, I believe, Google. And he's now the head AI scientist for you. So why don't you spend a little time on your team and why they're significant to the commercial launch?
Absolutely. No, it's such a great point. One of the things about being a company at our stage is we're small. And so it's every person is important, and every leader in each functional area is really important. So my background, after my MBA from Stanford, I have about 30 years of medical device development technology, was involved with a number of early advances, one of the first drug-eluting stents, lasers for cataract surgery, and really just found my niche in bringing disruptive technologies like this to market, really understanding how to bring a technology and how to get the evidence generated and get it into the hands of patients and physicians. So I am just incredibly passionate about this. And once I discovered Branislav and Heartbeam, I've been thrilled to be part of this team. And you're right, Lou, the rest of the team is just outstanding. So, hard to single out people. I mentioned Lance. He was the head of data science and AI at Verily, which is Google's healthcare spin out. And he came to us as a consultant, loved what he saw so much. He joined us full time. Richa, you mentioned, Richa Gujarati is our head of product. She was key in Apple designing the Apple Health applications and has brought that insight to us. We have a vice president of regulatory, Debbie Castillo, who worked at FDA. So really kind of top to bottom, the team are just stars in their area and are making just incredible contributions.
Well, listen, I'm extremely encouraged and thankful for the work that you're doing, just from a personal medical perspective, but also as an investor. So as a shareholder, thanks. I would love to keep in touch, maybe bring some other of the team members on for updates along the way. I'd encourage everyone watching, please take a look at Heartbeam. I think we brought up the chart before. Much to probably the chagrin of any CEO is watching volatility in their stock price, but this is how it happens in small, innovative companies. They're volatile until they take off and launch. So you see here, Heartbeam has had tremendous ups and downs. You need to have a position that you're a long-term holder in, and then maybe consider trading around that. Company has a pending FDA approval, hopefully sometime this year. So Rob, thank you again for joining us, and look forward to touching base again in the near future.
My pleasure, Lou. Thanks so much.
Alrighty, folks, at this point, we're going to take another break from a word from our non-existent sponsors. Yeah, your ad goes here. Today's episode of The Big Skinny is brought to you by Wow, This Spot Feels Empty, LLC, the world's leading provider of missed advertising opportunities. But don't worry, you can fix that. Imagine your brand right here, reaching thousands, okay, at least a solid handful of really intelligent, definitely influential listeners hanging on our every investment insight and tech take. Your sponsorship could help us keep the lights on, send our kids to college. Yeah, we've got a gaggle of them among us here. So at least some of the older guys here, Dodd. It can help us afford our sushi habit. So please don't let this golden opportunity slip away. Email info@thebigskinny.com and claim this space before we have to start selling plasma to fund the show. Don't want to do that. All right, we'll be right back. All right, we're back. Just like you're not supposed to have a favorite kid. My son, one of my sons is in the room. I'm not going to tell him if he's my favorite. He's my favorite right now because he's right here. I can't get in trouble for that. But just like you're not supposed to have a favorite kid, you're not supposed to have a favorite friend. And I got to be honest, our next guest has become quickly one of the favorite guys I love doing television with, spending time with, because he is just a true jack of all trades, just a true digger in finding the truth. He doesn't get misled by headlines, and he's just been a very successful guy, super helpful to me. So with great pleasure, I want to introduce you to Thomas Hayes of Great Hill Capital. Tom, great. Thank you for making time, my friend.
Thanks for having me, Luke. Wouldn't be anywhere else. This is going to be looking forward to this for a while.
Yeah, no pressure, man. We're going to just rely on your stock pick. So I gave a speculative micro cap. Save me later on in this discussion by giving our viewers some good conservative undervalued plays. So, hey, if you're good with it, I wanted to start with a couple of the topics I started off, just kind of part of the interruption style. Quick hit, what do you think? Agree, disagree, and tell me why. So is this bull market cooked, or are we still cooking with gas?
We're still cooking with gas. We just need to be a little bit more selective. I think, if you look at the S&P, is actually down now 0.5% year to date. But if you start to look at international and some of the other stocks, which you referenced in the A block, tremendous outperformance.
Yeah.
Europe up 15% year to date.
Yeah, my Italian brethren are up 19% alone. So we got to give a shout out to those Italians and Jersey boys like yourself.
That's right. That's right.
So where do you like in Europe? I mean, are you looking at particular opportunities? I mean, I know you run a more concentrated portfolio, wildly successful too, by the way, folks. This is not something Tom would ever say out loud. I have no problem giving him credit. He was right about Disney. I was wrong. He's probably going to be right about other big stocks. But where are you finding value now in Europe?
Yeah, in Europe, we're a bit more selective. The big arbitrage has been in the most unpopular region in the world, which is China. And I'm going to give you a stat right now, Lou, that's going to blow your mind. If you look at the Tremendous 10, which is the Chinese internet equivalent of the US Mag 7, the spread of outperformance year to date is 45% in China internet.
So that's companies like Alibaba. What are some of the names that run down that list?
Yeah, so Alibaba's up 64% year to date. If you look at my friend Brendan Ahern's K-Web ETF, China ETF, up 25% year to date. And if you look at the Magnificent Seven in the US, down 7.7% year to date. You can look at the ETF MAGS will give you the year-to-date performance on the basket. So what we're seeing, Lou, is we're seeing a weakening of the US dollar. We're seeing the 10-year yield bond yields come down. This all favors international. I really love that chart you put out earlier in your show about showing that while U.S. stock exceptionalism has been the norm for the last 10, 13, 14, 15 years, it actually moves in regular cycles every 10 to 15 years. And in the second term of Reagan, for instance, international stocks dramatically outperformed the U.S. after a long period of U.S. outperformance. So we can get caught up in recency bias and say only U.S. stocks because that's what's worked the last 10 years. But if we zoom out, which is a core of our framework, we'll see that these are regular cycles. And we've been talking for the last few months, lighten up on Mag 7 and start to get some international exposure, and that's
and I think it's a great point as you said it there. I want to make sure people caught the nuance. Start to get some international exposure, not bail out of all your U.S. exposure, but opportunistically. I mean, this is what we talk about as a tactical allocation, right? Like you have your mix, and then as opportunities present, I mean, as you said, I mean, even the beloved apple in my eye is trading at 32 times forward earnings right now. That's rich historically. I mean, you look at Alphabet, it's probably the most affordable at 19. But what valuations are you seeing in China? I mean, is it, are we talking 10 to 12 times, 14 times earnings? Like what?
Listen, you still can't give them away. This is early days. I mean, look. And by the way, I'm not sitting here to take any victory lap because as well as anyone else, I've been in BABA. This has been a position that we've been building for 2 years, and not on purpose. Okay, I mean, we started buying in the hundreds, and when it got
honey, sorry, I bought some more Alibaba.
yeah. When it got down to 60, we backed up the truck. So yes, we have a basis of 83 across all accounts. And we're very excited about that. But this is early days. I mean, basically, price is what you pay, value is what you get. They're still trading at 12, 13 times forward earnings, and growth is reaccelerating. You talk about Apple being expensive at 30 times relative to its historic multiple had been 14 times. What is, I wouldn't say concerning, but what is different is the earnings growth is low double digits, like 12% earnings growth and paying 33. If it was growing at 20%, then 33 would be very realistic. So I think that's why these things are taking a little breather for sure.
So great overview. I mean, great specifics on Baba. I know everyone is appreciating that. You said something, back up the truck. I believe this. I want to see if you agree, because I know we agree at least strategically on this. Small caps. Is it a back up the truck moment yet in small caps?
Yes.
Or is it? Oh, yeah.
Yes.
All right.
Unequivocally, yes. And by the way, and this feeds into the Mag 7 as well. So why have we been saying for months, trim back the Mag 7, get some international exposure? You nailed it in your A block. It all comes down to earnings. Yeah. So Mag 7 earnings growth is decelerating. Was 33% last year, going to be 16% or less this year. A lot of CapEx spending, unknown return on invested capital, 12, 24,
so
30.
Right. Like you can see that even in the cloud services growth, like quarter over quarter for all the bigs, like, they're making continual investments, but the growth rate there is just is decelerating. So that's happening. Right. What's happening with what I love I've stolen it from you. I hope you don't mind. It's flattery, right? I mean, I'm copying you. The magnificent 493. What's going on with them?
I thought a lot more people would steal that phrase. I say it every single week. We do a lot of the same shows together. It hasn't caught on. So maybe now that you say it, you're more handsome. People will listen. That would
debatable.
Be incredible.
I got a chuckle from everyone here in the studio, so they obviously don't believe that. But what's the growth rates looking for them? I mean, is it reaccelerating? Is it stable?
Yeah, exactly. So it was basically negative for a couple quarters. Then it got low single digits towards the end of last year. It's going to accelerate up to low double digits in coming quarters towards the end of the year, early next year, while the Mag 7 is decelerating. So there's huge opportunities under the surface. And small caps, depending which index you look at, Lou, Russell 2000, because they're coming off such a low base, 40% plus earnings growth. Small caps, S&P 600, 21% earnings growth. You can't give these away. They're in the gutter right now because of the tariff noise, but that's going to get resolved. Welcome to Trump 2.0, same as Trump 1.0, daily volatility, and we go up.
100%. I was on Varney on Monday, and they asked, what do you think about tariffs? I'm like, look, they're going to go into effect tomorrow on Tuesday, and I wouldn't be surprised by Friday if they're not in effect. And it took till Wednesday until they started repealing or revising some. So I think you're absolutely right. Great opportunities. I want to go, before we kind of close out here, is What's your thoughts on the Fed's next move? I think Jerome Powell is the Rodney Dangerfield of finance. He gets absolutely no respect, and rightfully so, because he's screwed the pooch on the front side of predicting inflation. But what do you think his next move is in light of all the market conditions?
Well, it's interesting. Looking at today, the odds of a June cut just went up to 85%. We talk about all these things that none of which were on people's bingo cards at the turn of the year, whether it's international outperformance, whether it's dollar weakening, whether it's yields compressing, or whether it's the Fed now cutting, which, just a few weeks ago, everyone's saying no cuts in 2025. We're going to get 2 cuts. At least 1 to 2 cuts.
Interesting. So you think 2? I've been on the record saying it's maybe 1, maybe none. That was a couple weeks ago. For me, the big sticking points were the categories of inflation that were stubbornly high. So food, shelter, and energy. Those are not things you can quickly correct. So my thesis has been that, look, we're going to get stubbornly higher inflation, stuck in the 3.5 range, and because of that, Powell's going to have to wait. But you think possibly 2 cuts, which at the end of the way, that Fed put's going to be worthwhile for stock investors. So it's a net positive for us.
Exactly. The more about, look, last thing I just want to say, keep an eye on the 10-year JGB yields. This is the most important chart that no one else is paying attention to. Those are climbing because the Bank of Japan has to hike to quell inflation, which is growing after 20 years of printing money.
Crazy, right? Like never ever did we think we would be in this situation in Japan with them coming off of
but this is key.
Rates.
If you look at the last peak was late July before you had that Mag 7 scare in early August. Yeah. A lot of hot money has come into the Mag 7, which is a very crowded trade. It's starting to uncrowd, but not crazily yet at this time. The more they have to hike to quell inflation, the more hot money is going to come out of Mag 7. So that's why the opportunities on Mag 493, small caps, international, etc. Doesn't mean you have to get out of these great businesses. It just means more moderation. And I think that's going to be a theme and opportunity in 2025 for sure.
Listen, man, you mentioned a bingo card. I don't know that you're old enough to be playing bingo, man. We're not there yet. Don't accelerate or race to Florida. I want to Dodd, who you'll meet in the D block. The Dodd block is from Florida, so man, I want to thank you. I knew it would be a great conversation. I want to, we have a little difference in opinion on Fed maybe this year, so we'll have to come back, revisit, see who's right, see who's wrong.
I think we're both going to be right, and it's going to be one.
That's right. Split the middle, split the baby. Hey, before we go, why don't you take last word to tell everyone how they can find you, what you do exactly, what's your bread and butter, so that they need to know about Tom Hayes.
Terrific. Well, Great Hill Capital manages money for ultra high net worth qualified clients and institutions and a lot of family offices. We run a concentrated equity strategy, a hedge fund strategy, and separately managed account format. So people can just we have a blog where we post all of our research. We have a hedge fund centric Hedge Fund Tips with Tom Hayes. It's the #1 podcast in the hedge fund category. We're more specialized in that regard. They can find everything at our blog, hedgefundtips.com, or on X @hedgefundtips. And believe it or not, we're big on TikTok. When we're not dancing, we go to official Hedge Fund Tips at TikTok.
Say that. My teenagers are going to available. While it's still available, the key. Listen, man, let me give everyone the skinny on Tom from my vantage point. I got to say, you are one of the most high integrity, high quality guys that I've come across in this business, which is hard to do in an industry that is riddled with greed and arrogance. You're super successful. No one would ever know how successful because that's just not the style guy you are. But I know you put in the work. You're prolific in content that you put out. So if people ever want to get more insights from Tom, I mean, you talk about your podcast. They're usually about 2 hours long, packed with great insights. And you've been doing it for 2+ years, 3 years now? What's the time?
5 years. We're on
5 years.
280.
280. And Tom told me when I was starting this, he's like, hey, man, I did my podcast for 2 years before I got any traction. So here's to you just for being just a stand-up quality guy, a good friend. I was glad when you said yes, you could join me on the first show. So, man, I would not want to start it any other way. So if anyone's more interested, go find Tom on Twitter, X. I can't get over calling it, Twitter. But yeah, check him out. And if you are looking for a new hedge fund manager to run some of your money, I could not give someone a more glowing endorsement. So, man, thank you again, and see you in the studio soon.
Very grateful, Lou. And all the feelings are reciprocated. And I want to thank you because Lou helped me out with some of the TV shows and everything else, and many things along the way. And that's what a good friendship is about. And I'll see you soon when I'm back in New York.
All right, brother. Safe travels. Be well. And let's go small caps.
Thanks, buddy.
All right, bud. All right, folks. Again, just always insightful conversations with Tom. He's really digging in. I encourage you to check out his work. You'll see it. We just got a snippet of it there in a quick conversation. We're going to take another pause for a word from our sponsor. And guess what? It's an actual sponsor. Here we actually have one. Are you looking for top quality, fully custom golf shirts and quarter zips really fast? Well, that's what Butcher Golf is all about. They got you covered. They take your brand, your promotion, or special event and bring it to life with full cut, sewn, and custom polos and quarter zips, starting from a blank canvas. So you can order as few as 25 or as many as you can imagine. Buy a lot. It's better if you buy more, and get them delivered to you in 21 days or less. So these are great things if you have a corporate golf outing, if you have a big company that you want to provide swag for your employees, or if you got that boys golf trip coming up, 25 boys, that's a big trip, but you should check it out. Stand out on the course, at work, at your next event with fully custom gear made just for you. Visit butchergolf.com today. And hey, mention the Sweet Lou deal, and they're going to knock 20%. I thought it was 20, man. We'll go 25. We're going to have to talk to them about that. You're at least getting 20% off for Sweet Lou. I'm not that sweet. I can't get you the 25. Place your first order at Butcher Golf, fully custom, really fast. Butchergolf.com. We got a real sponsor. We'd love to have some more. If you're interested, info@thebigskinny.com. We're going to be right back for a little bit of Q&A. So cue up the Pat Benatar and hit me with your best shot. We're back. Lou Basenese with the Big Skinny. This is the part of the show I hope I get a little relax a little bit. Maybe not. Maybe the questions are going to be fiery, but I'm going to crack a beer. This is our first show. Kind of a big thing. We pushed the boulder down the hill. We're live and committed Thursdays at 2 p.m. And at this point, I want to bring in my partner who is also a lifelong friend. We actually met, I don't even know, 2005, 2006. The man, the myth, the legend, Dodd of the D Block. Welcome to the show, Dodd. Glad to have you here with me, brother.
Certainly feels like a long time ago, Lou. It was 2005 or something like that.
It was. We were trying to launch an idea with some other guy to be nameless because we don't want to disparage the innocent. And he was just not a good dude. But we met there. You're a marketing genius and guru, really understand brand, and here we are. So the other thing I got to point out about Dodd is that he has been just a person in my life that can very clearly go, hey, that didn't make sense. You're speaking in a language I don't understand. That's too much finance, just like I would to him in terms of design and looking at things. And he's just been very good about that. So, man, thank you. thanks for being a part and agreeing to do the same. So you're going to lead the Q&A for us here, and you're going to share some things that maybe I screwed up earlier on, maybe didn't make sense. So where are we starting?
Well, we're starting first off. Where you screwed up is way too many UF references going on in this show. You know?
Coming from a UCF night, huh?
Go Knights, charge on! You know, so yeah.
Oh, Knowles. Oh.
So
sorry, folks. We're going to end this. We're ending this show very early and abruptly forever. I can't be with Knowles and Knights.
Let's pull that back a little bit, but you know. You're starting out pretty hot out of the gate here, saying that the bull market's going to last 3 more years, or you know, could be. You know, do you think that's pretty wise for someone starting up a new research company?
The irony is not lost on me that that's probably a thing that's going to work against me. Saying like, "Hey, stocks are going to go higher," and check out my new research publication where we may be talking about stocks and they don't go higher. But listen, I think fundamentally, earnings are growing. So can I tell you this bull market's going to last for 67 months like the average or 60 months like the median bull market? I have no idea. Maybe we get a 15-year bull market. Who knows? I mean, if the Fed starts cutting rates like Tom was mentioning, that's going to put fire back on the fuel, more fuel on the fire. Get your words right, Lou. Have one more beer, why don't you already? So yeah, I mean, I know it's going out on a limb some, but I wouldn't say it if I didn't believe it. Not about hype promotion. You're never going to see us market anything. We're just going to talk about what we're doing. So what else? What else you got for me?
Speaking of Tom, you know, can we pull some funds? Because I want to invest with that guy. You know,
Tom? Yeah.
Yeah.
I don't know that we get a line of credit here at the studio, but
I think his minimum might be a little higher, but than we can pull together. But yeah, definitely
one day.
Like to do that. Aspirations, of course.
I mean, look at this from Jeff Weingart saying that he enjoyed Tom Hayes' interview. Lots of great tidbits on the macro. This is true, man. Like you got to check out Tom. He's prolific. Find him on LinkedIn. Find him on X. You're going to get great insights from him. He sends out updates like, here's things I'm reading right now, 15 things I'm reading, 20 things I'm looking at. You are going to be inundated and well-informed. And I think that's why I wanted him to be one of our first guests, not just because I love him as a friend like you, is because he's insightful. And this is a journey together. I see this show and what we're doing is, hey, let's be educated together and share the insights that we have and do it in a fun format. So what's the next comment, question, concern?
Well, we've done disruptive tech together in the past, and I'm sure we have plenty of disruptive tech folks watching. Can you tell us, what's the difference between Big Skinny and disruptive tech? What can we expect different than the past?
Yeah, I think that's a great question. So for those that are disruptive tech members listening, former disruptive tech members listening or listening to a replay of this, I want to tell you thank you. I'm sorry I had to disappear for FINRA regulatory reasons and had to abruptly leave. I will be honest that, look, I'm still owning all those stocks, some much more heavily than others. Atomera, Q as always. What was different and what I've learned, and I think this is as investors, is even though you say, hey, only put a small amount in small and micro caps, if that's all you focus on in a research publication, an education publication, it's a really hard thing to do and manage, right? Because you're not seeing the other gains elsewhere because you're not making those recommendations. So I would tell you the big difference is going to be we're going to spend more time on education. We're going to spend more time on being generalists. So like European stocks are universally cheap right now. There's ways we can very easily make 20, 30, 40% of our money in an ETF. Why won't we do that? Just like I've done with Apple over the years. So instead of focusing exclusively on the innovators, the disruptors, we're going to add to the mix and have large caps, small caps, mid caps, ETFs, special situation opportunities that could be private. Most of them will be public, but we're going to cover the gamut and really provide it in a much more engaging environment. So we'll provide updates on the things we've done in the past. Heartbeam is a new investment. Don't be surprised in future weeks and shows if you see interviews with Q Biopharma, ClearSign, which is a flash from the past, as well as many other companies that we were looking at those times. But
hey, with that Heartbeam, like, how do I get one of those?
How do you get one of the Heartbeams?
Yeah.
Devices?
Well, they're not out yet.
I got a guy. That's why. Yeah. You're not Italian. I am. This is how it happens. So listen, there's actually, if you're interested, anyone listening, there is actually a wait list that is on. It's an early adopter list. I can't remember the exact name they use for it on their website, where you can submit your information, and as they lead up to getting the final FDA approval, hopefully this year, you'll be one of the first ones that they reach out to. So they're finalizing how their go-to-market strategy, but this is a device that right now in small volumes costs $300, $400, $500 to make. At volumes will be maybe sub 100 over time. It'll be a subscription revenue-based model. But, I mean, what are you willing to pay for something like this to cover your heart? I mean, I don't know. You tell me.
I'll give you $50.
I mean, no,
Can I have that
mine.
one?
I'm not selling mine.
I just want that one.
But think about it. Like, if I had peace of mind, it's worth. I have that one of those Whoop straps. I'm not wearing it, right? Like, I'll pay $40 a month for that.
Got a couple comments on Heartbeam.
Yeah. Hans, my good old friend Hans, doesn't expect healthy people like himself going to buy this cardiac device. Yes, I agree with you. So if you look at the addressable market for this, there's, I believe, about 3 million patients that are in intensive cardiac monitoring already, where they've had some type of event or that at high risk for a type of event. That's the immediate market for this. I would be surprised, though, that people, as you get older, I mean, depends on the price point, right? Like I was saying, there's other wearables out there, the Oura Ring, the Whoop strap, the Apple Watch that don't have and aren't anywhere close technologically to do this, that would be of interest. So I think there's a bigger market, but you work through the doctors first. That becomes a large addressable market that you can commercialize meaningfully.
I'm a relatively healthy person, and I would definitely want one of those. You know, as like you said, Lou, as we're getting older, I think that's a great thing. Yeah, for sure.
Listen, time will tell. They got to get FDA approval first. That's always the risk with med device companies, is you don't know, until you have FDA approval, you don't have customers. Your customer is the FDA. So that's something I'm hopeful as an investor the company secures before the end of the year. They got their first FDA approval for the device itself to monitor, to take readings. Being safe doing that. Next is the approval for the algorithms that actually detect and transmit or translate the readings into a synthesized 12-lead ECG. So it's an exciting company. Look, we're going to bring the team back. I talked with some of the head of ER's departments at some of the biggest ones throughout the country, doing my diligence on this. I'm going to try and get them on the show so you can hear firsthand really what the pain points are, what the markets are. But to Hans's point, look, you got to articulate what the market is a little bit better. We'll do that over time. And more than anything, appreciate the comments and the feedback and the interest. We're getting right. You got any last questions, man? I'm going to give it to you because we said we're going to do this for like 30, 40 minutes, and here we are at 50 minutes strong in.
I mean, the only question I have last is a little specific. My friend Diesel texted me.
Wait, you have a friend Diesel?
Yeah, I do.
Your name's Dodd. You have a Diesel.
Well, see, he put unleaded gas in his diesel truck twice, so now he's Diesel. But
rightfully so.
He wanted to know. He's like, please, we get Lou to say something about specifically Atomera and Q. Anything specific? I know stuff's coming up like down the road a little bit.
Yeah, I mean, you want me to be candid? We're on camera. Fireball CEOs. I mean, listen, this is the toughest thing in some of the microcap, small cap companies, right? Two things. One is management. It's always hard to know what management is capable of or not. It's no easy task, so this is not disparaging against them. Just if you're not right for the job, you need to move on. There needs to be a transition. The other thing is new technologies take time to disrupt markets. So the data on both Q as a biotech company and its ability to not cure, I won't go that far, cure cancer, but to prolong life meaningfully, but I'm talking about years in certain cancer indications, is undeniable. By the same token, so is the data on Atomera in terms of improving performance, its application across the entire $600 billion semiconductor market. It's just taking time to get pulled into market. And I would say it to their faces. I've said it before to Scott Bebo at Atomera. I think you either need to move over and bring someone else in, or you're going to be escorted out eventually. Dan Passeri at Q, love him, even though he's a Boston Red Sox fan. He needs some help there too. I believe in the technology, the science, and at the end of the day, when I look at tech investments, I don't ever fully bet on a jockey. I'm betting on the horse and the technology. So to Diesel out there, I'm holding strong, still holding those shares. I think we'll ultimately be vindicated. So appreciate the feedback. Don't go put diesel fuel in your unleaded car.
Hopefully not again.
All right. Well, man, until next show, we're going to sign off here. Dot, I want to thank you, man, for everything. I want to thank the guys in the studio, Dan and Taylor, my son LJ, my family far and wide, my wife. I mean, I could go on, everything, but I got to thank the wife last. I love you. Sorry I can't see you right now. See you soon. But I want to thank you, too, everyone else here listening and tuning in. You are part of history. We hope this becomes something that is a big show, a long-term running show, and more importantly, an informative and helpful show. So please, we'll be back here every Tuesday at 2 p.m. Thursday? Tuesday. See? Today's Thursday. You're helping me already. You're keeping my calendar straight. We'll be back every Thursdays at 2 p.m. If you got constructive feedback, share it. What would you like to see? Someone name guests you'd like to see, technologies you'd like to hear about, stocks, topics, whatever it is. shoot us an email at info@thebigskinny.com. And if you're not signed up for the newsletter, next issue's going out on Sunday, make sure you go there, bigskinny.com. Once again, from the bottom of my heart, thank you for taking a risk on me joining this show. Really excited about this next venture and where it leads. So with that, I'm Lou Basenese with The Big Skinny, signing off.